Hi everyone, Ali here again. So the question is, are we out of the woods yet? And the simple answer is, I don't know. And the reason is because, first of all, I am, as I've mentioned in my previous videos, I am not in the prediction business and I don't own a crystal ball. But all I can see is what indicators are we getting from the market and, where are we heading from chart standpoint, keeping a long-term view, big picture, right? Short-term view, Nasdaq came up to this 20-day moving average, and it closed above it. Good sign. But over here, I see this pattern over here, this diagonal higher lows and a flatter top, and it starting to look like a rising wedge, which is a chart pattern. And generally, what happens is as this wedge closes, the stock or the market, what have you, whatever you're looking at the chart for, it rolls over and goes down. So let's see. The time will tell. Same thing over here. S&P 500 making these higher lows, but flatter top, resisting at the 20-day moving average. As this gap closes, we are very close to, still close to this 12-year trend line. So let's see where we head from here. So, did the market do anything today? Well, one thing happened, which is pretty important, that the volatility came down, right? We were seeing those 10% up and down days. For a change, we have started seeing smaller percentage change in a day. Does that mean, are we going higher if the volatility is dropping? Not necessarily. I can't say one way or the other because the market, here's volatility right now. Here's volatility from back in 2008. This is where the volatility was at the peak of 2008. And somewhere around here, March of 2009, somewhere around here, is where we found the bottom in March of 2009. So volatility spiked and then it started coming down, but the market continued going down, right? So the market could continue going down in percentage terms, like a lower rate of change, right? Volatility is simply rate of change. So it can aggressively go down and there'll be huge volatility, or it can go down in a slower manner and it would be less volatile. That's all it means. So don't know if we are out of the woods yet, if the volatility is coming down. Here are S&P 500 sectors. So just wanted to show you that we have these are the sectors. Communication, this has Google and Facebook. Consumer discretionaries has Amazon. Staples has Walmart. Energy has ExxonMobil, Chevron, and other energy names. Financials has all those big banks. Healthcare has Pfizer, J&J. Industrials has United Technologies, Lockheed Martin, and airlines and Boeing in there too. In IT, Apple, Microsoft, and all the other tech names that you can think of. But then there are these three sectors: real estate, utilities, and materials, which make up very small of the overall S&P 500. And energy makes up very small of the of S&P 500 as well. But if we think about 2008, right, and the financial crisis, there were a lot of things that were going on. There were mortgage-backed securities. Then there were credit default swaps written by big banks, and then the financial condition of these big banks was they weren't adequately capitalized, and there wasn't enough regulation around what they could what they could do. So it put the entire system at risk. But now, energy, with the drop in oil prices and U.S. being energy self-sufficient, this is going to have a lot of toll on our energy production and distribution, and because it's exploration, it's refinery, it's pipelines, so there's a lot involved over here. Then With the businesses being in jeopardy, let's say, if there's a business that's about to that hasn't been doing well, and all of a sudden, coronavirus thing happens and you are forced to shut down, a lot of businesses might, they might just close shop, and just like we've seen in the past 12 years that the stock market's been going up nonstop, right? And we've had one of the greatest bull markets in history. Um, Real estate, it could, we've had similar inflation in rent. So if you want to call inflation in stock market, the stocks being very expensive, real estate and rents had inflation as well. So it's pretty challenging out there, and if businesses start shutting down, there will be a lot more empty commercial space, and it could hurt real estate sector pretty bad. And then in turn it could hurt, like, other sectors, because all these sectors, right, they use technology, they use financial sector, they use communication, right, and they use utilities. So if these businesses go down in like different sectors, even though they're very small in terms of the overall S&P 500 composition, they might not be small in terms of the overall US economy, right? There are a lot of people employed in these sectors. So today's news, title of this slide is jobs, 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 right? That's the most important thing, because that's what's going to keep people in, with jobs. They're going to keep fueling this economy. And it's with 47 million unemployed and 32% unemployment rate, is just unheard of. And if it's temporary, right? If let's say, if I'm at the brink of shutting down my business, am I going to have enough encouragement and concoct another idea right away to open up shop again and use cheap leverage provided to me by the government or the banks? Probably not. And if I'm at the verge of starting a new business, I'm probably going to take a back seat and say, you know what, let these things settle out. I hope I'm wrong. I seriously hope I'm wrong, because this is going to have serious implications. However, on the brighter side, I'm not trying to scare everyone. I'm just trying to, even for myself, right? I'm trying to make sense of these things. And that's why I'm not pounding the table of buy, 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 right? And I'm saying, just be careful. And if you want to buy, and if you're a long term holder, this is a perfect market for a stock picker. If you think in the next 10 years, or even next 5 years, 3 years, Microsoft, Google, Apple, Nvidia, like these technology names, and then some banks or some, like Walmart or Target, are they going to be around next 3 to 5 years? Probably. But there are many businesses with stagnant revenue growth, large debt, negative cash flow. It's gonna it's gonna be very challenging for them. So if you are picking stock for the long term, and that's what I'm doing for myself, first of all, I can't buy stock, but I'm only going to pick sectors that are prone to growth, and it just makes it easier for me. So I buy ETFs. But if you're going to pick stocks, focus on revenue growth, followed by low debt, followed by followed by positive cash flow, and they should be leaders in whatever they do, right? So those are some of the most important criteria to me if I were to do stock picking. But it just makes it very easy for me to just buy ETFs, because with diversification, overall risk goes down. So good news over here: China's manufacturing activity expanded, shows positive sign. And that's all for tonight. And I hope, I hope we can get out of this sooner, because the last thing we want is the longer it prolongs, the longer our main street is going to hurt. And as we saw that, overall composition of S&P 500 might not comprise of many of these sectors, but these sectors do employ a lot of people. So wish you guys all the best. Thanks. Bye.